For the last decade, the winning move with Bitcoin was simple: buy it and hold on for dear life. That strategy is now broken. The institutional capital you've been waiting for, it's finally here, pouring into massive exchange-traded funds, or ETFs. But there's a problem. They are not playing by the old rules. If you are still using the old HODL manual, you won't just be left behind. You will become their exit liquidity. Today, I will show you how to upgrade your strategy for this new era, so you can move with the smart money, not get run over by it. Let's be honest. The buy and hold strategy, or HODL, wasn't just a meme. It was a genius move for a long time. It was born from a deep understanding of Bitcoin's DNA, a fixed supply of 21 million coins and a programmed supply shock every 4 years, the halving. For a decade, that was all the alpha you needed. You didn't have to be a Wall Street quant. You just needed conviction and a lot of patience. The early believers, the retail investors, understood this better than anyone. They bought, they held through devastating price swings, and many were rewarded. The entire strategy worked because the market was driven by a fairly simple, cyclical story. A halving would come, the new supply would be squeezed. Media hype would chase the rising price, attracting a new wave of retail. The price would explode, then crash, and the cycle would restart. You could almost set your watch to it. But that game is over. Not because HODL is wrong, but because it is now dangerously incomplete. A new player, much larger and infinitely more sophisticated, has entered the field: institutional capital. Their arrival, triggered by the launch of Spot Bitcoin ETFs in 2024, has permanently changed the market structure. Thinking the old rules still apply is like showing up to a Formula One race with a go-kart. The track is the same, but the cars and the drivers are completely different. This isn't a distant theory. You can see it in the data right now. Since their launch, the Spot Bitcoin ETFs in the United States have become one of the most successful financial products in history. The latest data shows these ETFs have attracted tens of billions of dollars in cumulative inflows. As of mid-November 2025, US ETFs collectively hold over 1 million BTC, about 5 to 6% of the circulating supply. This isn't a trickle of money. It's a Wall Street fire hose, and it plays by completely different rules. And here is what you absolutely must understand. In most cases, these institutions do not HODL. They are not Bitcoin maximalists driven by ideology. They are asset managers and hedge funds driven by risk models, client mandates, and quarterly performance. They are professionals playing a game of percentages. Think about a massive pension fund with a traditional 60-40 portfolio. It won't go all in on Bitcoin. It will make strategic, often small, allocations around 2 to 5% of total assets. That might seem small, but a small percentage of a multi-trillion-dollar capital pool is a seismic force in the much smaller crypto market. These allocations have strict rules. If the Bitcoin position grows too large, say from 2% to 4% after a price surge, their mandate often requires a rebalance. They must sell to get back to their target. This creates predictable and constant selling pressure, even in the middle of a bull market. Conversely, after a drop, they are incentivized to buy the dip to bring the allocation back up. This dynamic dampens the parabolic spikes and epic crashes we were used to, but it introduces a completely new rhythm. The old cycle of retail FOMO and panic has been replaced by the cold, institutional mechanics of portfolio management. Ignoring this new rhythm is like trying to surf without watching the tides. So, how do you survive and thrive in this new game? Stop thinking like a pure hodler and start thinking like an institution. This doesn't mean abandoning long-term conviction, but adding a smarter, more active layer to your strategy. Here are 3 principles to start. Principle 1. Watch the flows, not just the price. Once, price was everything. Now, ETF flow data is often a more important leading indicator. Why? The price tells you what happened yesterday. The flows can tell you what might happen tomorrow. Every day, we get data on how much money is moving in or out of major ETFs like BlackRock's IBIT or Fidelity's FBTC. Days of heavy inflows often signal growing institutional demand. Prolonged periods of outflows indicate de-risking and possible downward pressure. You no longer have to guess the market's mood. Wall Street is practically broadcasting its moves. If retail is bearish but the ETFs are seeing inflows, that's a powerful signal that smart money is buying what others are selling. Principle 2. Understand the new world of diversification. The institutional playbook is not just Bitcoin. Bitcoin and Ethereum are the core assets, but then diversified portfolios are created to capture growth in various crypto sectors. This is where rotation comes in. The conversation is no longer just when to buy Bitcoin, but when to rotate profits. A key example is the RWA sector, real-world assets, meaning the tokenization of real assets like real estate, private credit, or U.S. Treasuries. The RWA market in 2025 is already between $24 and $35 billion. It's not a sideshow. It's the merger of traditional finance and blockchain. Other strategic flows are going into Ethereum Layer 2s, decentralized AI, and DeFi platforms. Upgrading your strategy means looking beyond Bitcoin to spot these emerging trends. After a strong Bitcoin run, it might be time to rotate some profits into RWAs for yield, or into a promising Layer 2 before it explodes. Principle 3. Adapt your risk management. HODL had one rule: hold on. The institutional approach is far more dynamic, and you can adopt its mindset. A large part of this is strategic rebalancing. Set target allocations, a core position in Bitcoin, a secondary in Ethereum, small speculative allocations in high-growth sectors. When one position grows too large, take profit and reallocate. This forces you to do what few can: sell into strength and buy into weakness. The more mature market also offers hedging tools. Bitcoin options and futures are deep and liquid. Knowing the basics, like buying a protective put, can defend your portfolio from the sharpest drops. Risk management is no longer about holding on during a 50% drawdown. It's about protecting your capital to be ready for the next opportunity. Navigating this new landscape is complex, and today we've only scratched the surface. If you want to keep receiving analysis that helps you stay ahead of the institutional waves and truly upgrade your crypto strategy, subscribe to the channel and turn on notifications. The game has changed. Buying and holding Bitcoin, while still an important part of a strategy, is no longer enough to win. The arrival of institutional capital through ETFs has brought new rules, new players, and a completely new rhythm. You now have a clear choice. You can stick to the old manual and hope for the best, running the very real risk of being beaten by those who see your conviction as their future exit liquidity. Or you can upgrade your mindset. You can learn to watch the flows, diversify with purpose, and manage risk with discipline. The wall of money is here. It can be a force that crushes you, or a wave you learn to ride. The choice is yours.